Now let's briefly talk about equilibrium exchange rate and exchange rate regimes. I'm going to first talk about how equilibrium price is determined in FX market using GBP USD as an example. Then I'm going to talk about the exchange rate regimes. Let's talk about the equilibrium price of the commodity apple here. And I'm going to use dollar per apple notations. Well, in the next slide, I'm going to replace apple with British pound, GBP. So this is GBP USD. Pound is in the denominator. Dollar is in the numerator, right? And this is the usual supply and demand, price and quantity. And we have supply curve like this and demand line like this. And when the demand curve meets supply curve, at this point, we have equilibrium price. Likewise, in FX market, equilibrium exchange rate ST, equilibrium quantity of foreign currency, will be determined from the intersection of this supply curve and demand curve, just like the Apple case. Back to Apple case. When there is more demand for Apple, let's say everyone now likes Apple more than before. So at each price, they're gonna demand Apple more. It means shift of the demand curve. And the new equilibrium price will be PT plus 1 and new equilibrium quantity will be QT plus 1, right? Likewise, in FX market, and I'm going to assume this one floating exchange rate. It means exchange rate will be determined by demand and supply in the FX market. Do we have different story about the equilibrium exchange rate? Yes, we do. So we're going to talk about that in exchange rate regimes. So here we assume that demand and supply will determine exchange rate. That's certainly the case for pound versus US dollar case in a usual situation. Let's say for some reason, now US investors think they have more incentive to invest into UK. So UK has bigger growth potential maybe. In those kind of situations, at every possible exchange rate, they will demand more pound. So the demand curve will shift. Now ST will move to new price ST plus 1. So what is the meaning of this? We are using GBP USD, by the way. If this number increase, that means for the same £1, now you have to pay more dollar. It means pound appreciate. So more demand for pound means pound appreciation against dollar. What about the supply curve? Back to the Apple case. Because of good weather, all the suppliers produce more apple and they supply more apple in the market. So at every possible price, there is an increase in supply, right? That means the new equilibrium price will happen here. It's a low price. In the FX market, again, we are assuming floating exchange rate. Let's say Bank of England made a decision to print more money in the market. Quantitative easing. At the all level of exchange rate, the supply of pound will increase in the FX market. Then we're gonna have new equilibrium here and the price will be going down. So what is the meaning of this one? Again, this is GBP USD. Decrease in GBP USD means for the same £1, now you have to pay less amount of dollar, which means pound depreciate. So more supply for pound means depreciation of pound. What determines the equilibrium exchange rate? What are the factors affecting demand and supply in the FX market? For example, given time limit, I put more emphasis in international financial market, so I don't cover that much material, the economic fundamental behind the determinations of equilibrium exchange rate. I just want to provide some example, some story about that. The first one is the faster economic growth and higher interest rate and expected return in stock and bond market. For example, if you expect to see faster economic growth, for example, in UK, that means to foreign investor, let's say you are US investor, you want to invest into international stock market. And now you see UK has a higher potential for faster economic growth in the future. Then you have more incentive to invest into UK market. That means you're gonna demand more pound for that investment. As a result, the pound will appreciate for that higher demand. Sometimes investors think they could earn higher expected return by investing into certain country, many case emerging market country. What is the meaning of combined with an expectation that currency will stay the same or appreciate? We're going to talk more about this one in topic 4 and topic 5. When you invest into foreign stock market, for example, you are not just investing into stock market, you are also investing into foreign currency. Because when you invest into foreign stock market, you first need to convert your money into foreign currency. You're buying foreign stock using that foreign currency. After one period, you're going to convert your foreign currency investment back into domestic currency. When you do that, in fact, you are also buying foreign currency. So in this example, when you expect higher expected return in certain countries asset market, actually you are not just investing into that asset market, you are also investing into that country's currency. That means higher demand for that currency and appreciation of that currency. So either faster economic growth, or if you expect higher expected return or higher interest rate in the future, there will increase demand for that currency will appreciate. Normally, stock market investment is a short-term investment. You're going to realize the profit within a few months. Now, another example of the important factor behind the equilibrium exchange rate is long-term capital inflow, such as foreign direct investment. You're going to learn foreign direct investment in second semester. When we say long-term, it means the investor tend to realize their profit after a few years. For example, around 2000, there was a surprising strength of the dollar value, especially versus the euro. Dollar appreciated against the euro. It coincided with a clear increase in the long-term FDI inflow from the Eurozone to the US. The reason for that was the US internet and technology boom around that period. So when Eurozone investors think they have more incentive to invest into US market for a long period, that will increase the demand for dollar. As a result, dollar will appreciate. Another important factors behind the determination of equilibrium exchange rate is the government and central bank interventions. In particular, many governments in emerging countries, they use a combinations of capital control and currency management. We're going to talk about one example of currency management called PACS in the next slide, using these instruments to support their currency value. So there's a famous example of this one, currency war between China and US. This approach tended to stabilize their currency for a certain period in the short term, but in the long run, it tended to cause sudden large movement like a currency crisis. We saw these crises and in Latin America for many times. If you are interested in this one, just take a look at Baker-Hardwick, chapter 5. I want to talk about exchange rate regimes. It's in Baker-Hardwick, chapter 5. The first exchange rate system I want to talk about is the free floating. So free floating means equilibrium exchange is determined by demand and supply in FX market freely. But in reality, all central banks intervene at least a few times a year, at least. So free floating is actually the matter of degree. But when we think about dollar, euro, yen, pound, Austrian dollar, New Zealand dollar, Swiss franc, and Canadian dollar, most of G10 currency, these currencies tend to float freely most of the time. Now I want to talk about the fixed exchange rate regime, packed exchange rate regime. In this system, either government or central bank, they announce they're going to maintain certain exchange rate against major currency, US dollar or euro. For example, Danish krone, Swedish krone, Norwegian krone, their exchange rate are pegged to euro, and Hong Kong dollar is pegged to dollar, and Chinese yuan used to peg their exchange rate against dollar. Now it's not. In the next slide, we're going to talk more about this peg system. So first of all, the currency value is fixed to a benchmark, dollar or euro or other major currency, or sometimes a basket of major currency. Exchange rate may fluctuate within narrow bands, plus and minus 1% around that fixed exchange rate. Central bank will intervene in the market to maintain these bands. For example, if there's an excess demand for Hong Kong dollar, if Hong Kong Monetary Authority doesn't do anything, Hong Kong dollar will appreciate. But Hong Kong will intervene to maintain its fixed exchange rate by supplying more Hong Kong dollar to FX market. When central bank supply its own currency, it will give downward pressure, depreciation pressure of its own currency. So excess demand and excess supply will be cancelled, and it will be able to maintain this fixed exchange rate. When there's excess supply in the FX market for some reason, central bank will intervene. They will buy its own currency, so they will provide excess demand for own currency. Excess demand and excess supply will be cancelled, and they will be able to maintain the fixed exchange rate. When you try to develop a FX investment strategy of the currency with pegged exchange rate system, obviously you have to take into account what is the government policy, what is the response of a government policy to the event happening in the FX market. By the way, when the central bank intervened, they spent lots of FX reserve in their central bank. Often, if they intervene too much in FX market, they could squander away all FX reserve they have. This could cause the currency crisis, sudden collapse of its domestic currency. And central bank intervene sometimes by using interest rate adjustment and sometimes by capital control. Exchange rate policy vary across country at a given time, and it varies over time even within a given country. It's not easy to classify a certain country's exchange rate regime as one thing or other. IMF STEP developed a method to classify exchange rate regime of many countries using this table. They call this as the two-factor exchange rate regime. Two-factor means in practice. They differentiate between announced exchange rate regime and two-factor exchange rate regime. For example, certain country could say our exchange rate could fluctuate freely in the market, but in reality they intervene a lot. So they announce to claim their currency free float, but in reality, in de facto, they have different exchange rate regime. Now, IMF STEP classify exchange rate system from hard fixed one, hard pegs, to completely free floatings. So, for example, hard peg means they don't have their own currency. There are some countries just using US dollar as their major currency. So hard pegs. Soft peg, they fix their exchange rate and they try to maintain certain bands. The pegged exchange rate with horizontal bands, and there are system called crawling peg, crawling band, so it allows some fluctuations sometimes. If you are interested in this one, just take a look at Baker Hardwick chapter 5.